Hi, welcome back. In my last session, where I gave you an overview of what corporate finance is as a discipline, I talked about three decisions. The investment decision, where a business decides what projects to take, what investments to make, what assets to acquire. The financing decision, where you look at the mix of debt and equity. And the dividend decision, where you decide how much cash, if any, to return to the owners of the business. In this session, I want to focus on the investment decision, why it's so critical, and how its effects vary depending on where you are across the life cycle. So let's step back. If you're a business, one of the fundamental decisions you got to make is whether to invest in a project, an asset, an acquisition. Now, the assessment process itself, if I were to describe it, is a pretty simple one. You're a company, you're looking at a project. Here's what you're supposed to do. You're supposed to estimate the expected revenues, earnings, and cash flows you will make if you make that investment. And then you have to look at what hurdle rate, what rate of return you will need to make on the investment to break even. Now, in making these assessments, though, you're looking at a blank slate. But as an analyst in a company trying to make these estimates, here's some of the things you're going to fall back on. If you're trying to estimate the earnings and cash flows in a project, and you've taken similar projects in the past, of course you're going to look at past projects to see the pattern of earnings and cash flows. In other words, if you're Disney looking at building a new Disney theme park, you're going to look at the existing theme parks to get a sense of, hey, what are the cash flows and earnings going to be on this theme park? So you're looking at project history. Second, you're also looking at other companies in the industry. What are their experiences in terms of similar projects? And especially if you have some of these firms be younger or older than you are, you're getting a sense of differences across firms depending on their age. And thirdly, you're looking at information on the market that you're trying to attack with this project. How big is the market? What is the consumer process? How do they make choices on products and services in this market? Now you're saying, so what? Now, if you think about those three forces that you use to make estimates, they're more accessible and available for some companies than others. And if you bring the life cycle into play, older companies, more mature companies have probably taken similar projects in the past. I'm not saying that existing companies or older companies don't take projects in new businesses, but for the most part, they've experienced, they can draw on the past experience. They can also look at other companies in the business to get a sense of what the numbers will look like, and they have a pretty good sense of the market. Younger companies, on the other hand, don't have that history, don't have access to the data that you can use to make estimates. You're still trying to make estimates, but you make it with far more uncertainty. Now, if you look at hurdle rates again, you draw on data to make your best estimates. Though that data can include your past earnings history, because that's going to give you a sense of how volatile your business has been, past price history if you're a publicly traded company. And if you borrowed money in the past, you have a sense of what rate you can borrow money at and what terms that debt will come with. Again, that process is going to be easier if you're a mature company than if you're a young company. What I'm trying to argue is while the process of investment analysis is the same for every company, the ammunition, the information you have to make that assessment is far more available for more mature companies than younger companies. But ironically, as we will argue in this session, it's far more critical for younger companies to make this decision right than for more mature companies. A young company might not be able to survive a big investment mistake. A more mature company might be able to. So with that lead in, let's first talk about hurdle rates. Now, earlier in the last few sessions, I introduced the notion of a financial balance sheet. On the left side of the balance sheet, or the asset side of the balance sheet, you have your business, your existing assets, investments you've already made, and growth assets, investments I expect you to make in the future. On the other side of the balance sheet, I said there are two ways you can fund a business: borrowed money, debt, or your own money, equity. Here's what the cost of capital tries to do. It tries to attach a cost to each of those components. The borrowed money, it says, what is the cost of debt, the rate at which I can borrow money? And the people lending you money will charge you a rate that reflects your default risk as a company. Equity, though, might come from yourself, it might come from venture capitalists, it might come from public equity investors. You're trying to assess the risk that equity investors see in your company or your project, and the cost of equity is supposed to reflect the risk of the project to equity investors. The cost of capital is a weighted average of those two numbers. Incidentally, on the cost of debt, there might be a tax benefit you get. If you're able to claim interest expenses as a tax deduction, that has to be factored in. The cost of capital is a weighted average of your cost of equity and your after-tax cost of debt. That's what we're aspiring to do. Now let's build up to how we try to estimate these numbers. Let's start with the easier component. The cost of debt is the rate at which you can borrow money today. Generally, it has to be a long-term cost of debt because investments tend to be long-term. So to get to a cost of debt, I need to start with a risk-free rate, the rate at which I can borrow money if I can guarantee that I can repay it. That risk-free rate will vary across currencies. We'll talk about why, but that's your starting point. To that, you add a default spread. What's a default spread? It's an additional spread that a lender is going to charge you because they perceive you as having default risk. Obviously, this will vary across companies. And there are services out there that measure this default risk, in particular ratings agencies. So many people fall back on those bond ratings. You don't have to, but if you have them, you can fall back on them as a measure of default risk, and that gives you a default spread. Risk-free rate plus default spread gives you your cost of borrowing money. But as I noted earlier, governments across much of the world give you a tax benefit when you borrow money, which is interest is tax deductible. What does that mean? If you borrow money at 7%, I'm going to allow you to take the interest you pay on that 7% interest and claim it as a tax deduction. If your tax rate is 30%, that effectively means you're borrowing money at 4.9%, not 7%. So how do you come up with the 4.9%? 7% times 0.3, the 30% tax rate gives me a 2.1% saving. The after-tax cost of debt is the rate at which I can borrow money with the tax benefits incorporated. That's my cost of debt. The cost of equity is a bit of a mess, especially if you're a publicly traded company. Why? Because you could have tens of thousands of shareholders, each of whom has a different number in their head. But again, if you step back and think about building up to a cost of equity, here are the ingredients. You start with the risk-free rate. The same risk-free rate you started the cost of debt with. And again, it's got to be long-term and it's going to vary across currencies. But you need two other ingredients to get to the cost of equity. The first is you need an equity risk premium. This is the price of risk in equity market. It has nothing to do with your company or project. It measures what investors are demanding for investing in equity as a class. That number can vary across time. It can vary across countries, but that's that additional risk premium. And you multiply that equity risk premium by a measure of relative risk. What does that mean? Some companies and projects are riskier than average, and I should be demanding a higher cost of equity. So relative risk measure 1 basically means you're about as risky as the average company. If it's above 1, means you're more risky. Below 1 means you're less risky. Now in finance, we've concocted a Greek alphabet called beta to measure it, but it's really a measure of relative risk. Those become the ingredients you need for the cost of equity. So let's start with the risk-free rate. Risk-free rates, as I said, are currency-driven, and the key ingredient that drives differences in risk-free rates across currencies is differences in inflation. To get to the risk-free rate, though, here's one way you can go. You can start with the government bond rate. Now, if you view the government as default-free, you can stop there. The Swiss government bond rate gives me a risk-free rate in Swiss francs. Does the US government bond rate give me a risk-free rate in US dollars? For the moment, you might say yes, but it's up for grabs if the US government becomes viewed as having default risk. Does the Brazilian government bond give me the risk-free rate in Brazilian reais? I don't think so, because there is default risk in the Brazilian government. So here's what I do. I start with the government bond rate, that's in this graph, that's the height of the entire line. And then I subtract out the default spread. See this red portion? That is the default spread to get to the risk-free rate in that currency. At least in July of 2022, when I did this, the Zambian kwacha government bond rate was in excess of 25%. But there was a lot of default risk in the Zambian government bond. You net out that default risk, you end up with a risk-free rate of more than 15% in Zambia and Kwacha. And if you look across currencies, you'll notice that there are currencies with far lower risk-free rates, and in fact, even some currencies with negative risk-free rates. You're saying, how can that be? Remember we said inflation is the key driver of risk-free rates? High inflation currencies will have high risk-free rates. Low inflation currencies will have low risk-free rates. And deflationary currencies could have negative risk-free rates. So your starting point is a risk-free rate, which means when you want to do investment analysis, you have to make a currency choice. You've got to estimate the cash flows in that currency, your discount rate in that currency, your hurdle rate in that currency. Your risk-free rate becomes that ingredient that determines that hurdle rate. Your second step, especially if you want to compute a cost of debt, is to come up with a default spread. Earlier, I talked about default spreads coming from the perception that you might not pay your lender back. Now, over time, we have agencies or services that have built up to assess that default spread in companies. And you might have heard of them, Moody's, S&P, Fitch. And what do? They assess a letter grade to your company based on default risk. And it goes from AAA, which is the safest possible company, down to D, which means you're in default. And how does that help me? If your company has a bond rating, triple B, double B, I can assess the default spread for that company because there are other companies out there with that similar rating who have bonds. Those bonds are traded, and because they're traded, I can observe the interest rate they trade at. So as an example, let's say the risk-free rate is 4%, and triple B rated bonds trade at 6%. The default spread I have for a triple B rated bond is 2%. And if your company has a triple B rating, that would be the default spread I attach to you. Now, of course, you're saying, I don't trust ratings agencies. That's possible, in which case you can assess your own measure of default risk and come up with a default spread. But the more default risk there is, the higher the default spread will be. Incidentally, it's worth noting that these default spreads do change over time. Why? Because people change their views on risk. If you're in a market which is in trouble, in crisis, you should expect default spreads to widen. In this graph, you see how default spreads have changed over time from 2015 all the way to 2022. So you've got a risk-free rate and default spreads. You can build up to a cost of debt. Let's talk about the equity risk premium. The equity risk premium, as I described it, is the price of risk in the equity market. Now, will that change over time? Absolutely. Why? Because people change their minds on risk again. Fear factors rise and fall. And to get a sense of how much equity risk premiums can change, even in a mature market, take a look at this graph. This is my assessment of the equity risk premium for the S&P 500 over time. Notice how much it's varied over time. Take a look at the 1970s. High inflation pushed up risk premiums. Take a look at the 1990s. The dot-com boom and the feeling that risk had gone away pushed down risk premiums. Then take a look at 2008, crisis jump in the equity risk premiums. But basically, equity risk premiums reflect the price of risk, and that price of risk can change over time. Which brings me to an added component. That equity risk premium you saw on the previous page, the equity risk premium for the S&P 500. Let's think of that as a mature market premium. Will equity risk premiums be different in different parts of the world? Of course. I do assess equity risk premiums for countries. And the way I assess the equity risk premium for a country is I start with the US premium, my mature market premium. Then I look at the sovereign rating for a country. So if you look at this picture, in this column right next to the country, you see in blue the sovereign rating for the country. What's a sovereign rating? These are Moody's ratings that assess how much default risk they see in that country. I take that rating and convert to a default spread. That's a red. And then I scale that default spread up for the fact that equities are riskier than bonds. And what you get as your total equity risk premium, the red is actually my country risk premium, that added risk premium that I get by multiplying the default spread by the scalar. You add that country risk premium to my mature market premium, you get an equity risk premium by country. This is my graph as of 2022, but on my website I have the updated numbers at the time that you might be watching this. Check them out. Bottom line, when you're a company looking at taking a project, not only do you need to tell me what kind of project it is, but where in the world you're planning to take that project. GE taking or Disney opening a theme park in India will have a different hurdle rate, even if everything is done in dollars, than Disney opening a theme park in Frankfurt. So you got risk-free rates, you got default spreads, you got equity risk premiums. Let's talk about relative risk or beta. Now I know that if you've taken a finance class, you've seen the ways in which we can estimate betas. And often we get lost in those estimation approaches, running regressions of returns on the stock against returns in the market. But if you step back and think about what is it that drives that relative risk or beta, why is it that some companies have betas greater than 1 and less than 1? It comes down to fundamentals. It comes down to 3 choices you make as a company. What kind of business have you entered? If you're in a business of providing discretionary products and services, discretion in the sense your customers can live without the product or service, you're a riskier company than one that provides non-discretionary products or services. A grocery store should have a lower beta than a department store, and a department store should have a lower beta than luxury retailers. The first thing I'm going to look at is what kind of business are you in. Second, I'm going to look at your cost structure. If most of your costs are fixed costs, you have high operating leverage, you should be riskier than a company whose cost structure is more flexible. Why? In good times, if you have lots of fixed costs, you make lots of money. In bad times, you lose lots of money. Businesses with high fixed cost structures should have higher betas. And finally, because beta measures risk to equity investors, you can take a safe company and make it risky by borrowing money. Why? Because when you borrow money, you create a fixed cost, interest expenses, which you have to make in good times, not a problem, but you also have to make in bad times. It makes your equity earnings more volatile. What kind of business are you in? What kind of cost structure do you have? How much have you borrowed? All of those go into your beta. This process of estimating cost of equity is the same across all companies, but the amount of information you have is going to be far greater for a mature company that's been around, it's publicly traded, it has a bond rating, than for a young company. The process doesn't change, but the estimation challenges do. One of the things I find helpful in estimating hurdle rates is I compute a cost of capital for every publicly traded company in the world, for 48,000 companies, and I create a distribution of cost of capital. What does that tell me? It tells me what a typical cost of capital is. What's a high number? What's a low number? When I have to come up with a hurdle rate for a young company, rather than try to torture myself by going through the entire process, I might just say, look, it's a risky company. I'm going to give them a cost of capital that is roughly at the 90th percentile. So when you look at a distribution of cost of capital, you're getting a sense of how much cost of capital vary across time, and you can use this decile to come up with cost of capital. Just to back up what I just said about cost of capital being higher for younger companies because there's more uncertainty, I did compute the cost of capital, the median cost of capital for all publicly traded companies, then broke them down by age decile. Remember, we used age as a rough proxy for where a company is in the life cycle. The youngest companies have a median cost of capital of 9.27%. The oldest companies have a median cost of capital of 7.03%. Clearly, your hurdle rates are going to be higher for younger businesses simply because you're riskier. Doesn't always have to be the case, but in general. Now, incidentally, if you're a young company that is not publicly traded, I would make one adjustment to that cost of capital you saw on that previous page. Implicit in that cost of capital that you saw in the distribution on the previous page was the assumption that investors are diversified. What does that mean? That they can remove the risk that is not market risk, that they can diversify away that risk. That makes a big difference, especially at young companies. But what if you have a young company where investors are not diversified? I've expanded my relative risk measure to bring in the rest of the risk. I call it a total beta. What does that do? It increases the risk for every company because you're now bringing in that risk you were removing in the previous scenario. It pushes up the cost of capital for a company. And if you look at the cost of capital now, you get much higher cost of capital for every company if you look at total risk. But here again, the pattern stays the same. The youngest companies have a median cost of capital of 25%. The oldest companies have a median cost of capital of 12%, even if they're all owned by completely undiversified investors. So the hurdle rate is obviously going to vary for across businesses, and I would extend this to individual projects as well. And all those ingredients play out in what this number will be. So that's a hurdle rate part of the discussion, and you can see why the challenges get greater for younger companies. Let's talk about investment decision rules. One of the most commonly used investment decision rules in the world is looking at accounting returns. What do you do in accounting returns? You take a measure of accounting earnings and you divide it by a measure of what accountants say you've invested in a project. I'm not, generically that's a definition of an accounting return. But let's cut down to specifics. If I'm looking at equity investors, the accountant's measure of income to equity investors is net income, and the accountant's measure what's invested in a project by equity is the book value of equity. Net income divided by book value of equity is called return on equity. So that measures accounting returns to equity investors. But what if I were interested in measuring returns to all investors? Remember, you have both equity and debt as capital providers. The measure of income to all investors, equity and debt, is operating income, earnings before interest and taxes, earnings before I pay the debt holders. Of course, if I'm looking at after-tax measures, I'm multiplying that operating income by 1 minus the tax rate to get a measure of what I will generate after taxes. But look at the capital invested in a project now. I'm not just looking at book equity, I'm also looking at the debt invested in the project. And to the extent that cash is not invested in operations, is unable to earn operating income, I net the cash out. Book equity plus book debt minus cash is called invested capital. Dividing after-tax operating income by invested capital gives me an after-tax return on invested capital. It's an accounting return to all investors. Companies around the world use this to judge, not just themselves as companies, but individual projects. But if you look at the inputs you need, you can see those inputs are going to be easier to get for some companies than others. Just to get a sense of what accounting returns look like for entire companies across the life cycle. Here's what I did again. I broke companies down by age decile, from youngest to oldest, and I looked at return on capital and return on equity, defined the way I did across companies. Take a look at return on equity. If you look at the youngest companies, they have very low or negative returns on equity. And as you look at more mature companies, you see the return on equity go up. And you see the same phenomenon play out with accounting returns, perhaps to a lesser extent. Return on equity in particular is difficult for younger companies because book equity can often turn negative if you're a money-losing company. But neither accounting return works very well for young companies because the numbers are in flux. It's much more difficult to get trust in those numbers. So I'm not saying you cannot compute accounting returns for a young company. What I am saying is you might not have much faith in that number because of the inputs that go into it and how unstable they are. Now, if you're doing this on individual projects, you're going to run into the same issue. It's more difficult to measure and trust accounting returns at young companies than at older companies. The other set of investment decision rules look at not just cash flows, but time-weighted cash flows. And there are two ways you can compute time-weighted cash flow returns. One is to compute the present value of every cash flow in a project, add them all up and come up with the net present value. And if that net present value is greater than zero, you have a good project. If it's less than zero, you have a bad project. The alternative is to take the cash flows and try different discount rates till you come up with that discount rate that makes the present value of the cash flows, the net present value of the cash flows, zero. It's called the internal rate of return, which you then compare to your hurdle rate to make a judgment on, is this a good investment? They're saying, well, what's different about this across the life cycle? For every company, you've got to compute expected cash flows, and you've got to come up with a hurdle rate to discount or compare those cash flows to. But it is true that NPV and IRR, while they're both time-weighted cash flows, have some differences, and maybe these differences might come into play as to which one you pick depending on where in the life cycle. The first is NPV gives you a dollar value, an absolute value for a project. So I'll tell you the NPV for this project is 12 million, 2 million, minus 5 million. IRR gives you a percentage return. You're saying, so what? NPV, because it is scaled to dollar values, is biased towards bigger projects. Bigger projects, if they're good projects, will have higher NPVs than smaller projects. IRR, because it's scaled to what you invest, is biased towards smaller projects. We will argue, and this is, I think, true for the most part, that younger companies are much more likely to have limited capital. Why? Because they don't make money. They don't have internal cash flows. Access to capital is limited. And if you have limited capital, maybe you want to get the most bang for your buck. Maybe that might explain why more young companies are likely to use internal rate of return, but more mature companies might go with NPV. The second difference between NPV and IRR is a project can have only one net present value. It's unique. But a project can have multiple IRRs. Why? Because an IRR, and I don't want to get esoteric here, is the root to an equation. And every time you have a cash flow sign change in your project, you have an additional root. You say, what are you talking about? In a typical project, you have a negative initial investment, which is negative, and then your cash flows turn positive. And they stay positive. You have one sign change or one IRR. But if you have a 20-year project where every 5 or 10 years you got to make a big investment, you could have negative cash flow up front, positive cash flows for the next 4 years, negative cash flow in year 5, and you might see this recurring in year 10 and 15. You could have 3 or 4 IRRs for the same project. It's a bit of a pain because you're saying, which IRR do you use? It's a problem with IRR, and it's more likely to show up at young companies where projects have unstable and sign-changing cash flows. And finally, and this is, behind the background, you don't notice it, the NPV makes an assumption about reinvestment, that you can reinvest at the cost of capital, at the hurdle rate. What do I mean by reinvestment? Remember, if you have a 5-year project, you have cash flows in year 1, year 2, year 3. Something has to be done with the cash flows. The NPV assumes you reinvest those cash flows at the cost of capital. The IRR assumes you reinvest those cash flows at the IRR. Again, where you're in the life cycle comes into play. If you're a young company with dozens of projects, you have lots of great projects to pick from, the IRR's reinvestment assumptions might be reasonable. You're a more mature company where you have a good project but not that many great projects, the NPV reinvestment assumptions might come in more handy. What I'm arguing for is when you're asked is which one is better, NPV or IRR, the answer to that might vary depending on where in the life cycle your company is. So you got accounting returns, you got these time-weighted cash flow returns. There's a third approach to investment decisions, which is called real options, where you argue that you have to assess an investment not based on what it has now, but what might happen in the future. The essence of options, the understand options, is to think of them in terms of payoff diagrams. What options deliver is limited losses and potentially unlimited projects. So you could actually argue that if you can have a project that right now is not viable, a technology that's not viable, but if you wait, that project or technology could become viable. Why? Because cash flows change. There's uncertainty about the future. This is true in every business, but you can already see why the draw of real options is greater at young companies where there's far more uncertainty about the future. There is more optionality at young companies because there is more uncertainty. More things can change. What that effectively means is you will sometimes take investments or look at investments or keep investments that are not viable, that are bad investments, if you look at them in terms of the status quo, existing cash flows, existing estimates of cash flows. But there could be optionality there because of the uncertainty. Again, differences across the life cycle might play out in whether you attach value to that optionality. So as you go through the life cycle, you will have to make investment decisions. That investment decision is far more momentous and significant early in the life cycle because so much of your value comes from growth. But the irony is the ammunition you have to make those investments well, both in terms of estimation and decision rules, is far looser, far more shaky early in the life cycle. So as you go across the life cycle, you can see your challenges in investing change. Early on, You're making assessments of cash flows without any history of projects. Later on, you worry about the fact that the business itself might be changing. The biggest mistakes that young companies make is they say, look, it's so difficult to estimate future cash flows. I'm not even going to try. I'm just going to pick projects based on gut feeling and intuition. The problem that mature companies make is because they have so much data, they tend to let the data drive project analysis. They don't bring in any intuition into the assessment. In terms of investment techniques, don't be surprised to see the technique you use change as you go through the life cycle. For startups, you're essentially looking at almost entirely real options. For young companies with capital rationing constraints, you might see IRR come into play. For mature companies, you're more likely to see NPV and accounting returns be more used. And as you look across the life cycle, the kinds of investments you make will also shift. Early on, investments will tend to be organic, internal investments. As companies mature and they start running out of organic investments, they will reach. Reach in what sense? Try to do acquisitions. So the investment process is always the same, but the kinds of challenges and estimation questions you face will vary depending on where you're in the life cycle. I hope you found the session useful, and thank you for listening.